Hey guys, it's Kat and Dean here from Kernel. Today we're going to be running through the first stage of how to design a portfolio. So thinking through things like asset allocation and the different considerations, or sort of the 3 to 4 top tips that you really need to think about when you're putting your portfolio together for the first time or doing a review. So we're going to keep this nice and short, probably, about 20 minutes. We do have a few slides and things to show you today, and it'll really just be an intro into getting started and what you need to think about. So for us, the place that we always like to start with when thinking about a portfolio is you and your goals and why you're investing. So that's really your starting point. And what we wanted to show you was we actually asked this of some of our customers and investors recently, and this was the response that they gave us. So as you can see here, quite a few different reasons for investing, but the one that really stuck out to us the most was that an overwhelming percentage of people are investing to grow their wealth, but they don't have a specific goal in mind. Now, this is a great ambition to invest to grow your wealth, but it does make it a little bit challenging, I think, if you don't have a particular goal in mind, to then figure out how to best design your portfolio. And the reason being with that is, how do you factor in things like when you're going to need the money, what kind of risk allocation you can take, whether you need defensive assets, like income producing assets, or you need growth assets like equities, if you're not really sure what the end goal is. So although it can be a little bit challenging and possibly a bit airy-fairy for some people, definitely worthwhile thinking through, what is it that I'm investing for? What is it that we're trying to achieve? And just jotting a few things down so you've got a bit of an idea in that sense. So I think, for us, thinking about me personally, we definitely have an investment portfolio that is for the future. But when I think about that goal, I know that it definitely has, at least a 15-year time horizon. So that makes it quite easy to make some subsequent choices. Whereas some other goals that I've previously saved for through investing, like saving towards my first home deposit, I did that through an investment portfolio. That was a much shorter time horizon. We were sort of looking at 5 years at that point in time. So therefore that really, that shorter time really impacted the types of investments we put in our portfolio when we were saving for that goal. Anything you want to add to that, Dean, or just?
No, I think generally the great thing about the survey responses was that probably a lot of people that are investing with Kernel have got a relatively long time horizon. And so it's really promising. So and hopefully with a couple of things we talked through, that'll make it a little bit easier. You can keep things relatively simple. And that's probably the other key thing here, is you don't need to over-engineer anything or overcomplicate it, but just think through a couple of these questions and they'll give you a really good starting place.
Yeah, cool. So once you've got your goals, that's sort of step one. The next part is really putting a time frame to those goals, and we like to call that your horizon, or your now, soon, later. Horizon seems a little bit far away, and it is challenging regardless of your stage of life to perhaps get excited about something that's 20 years away. So really thinking about it in simple terms of now, soon, and later is a good place to start. So I'm just going to talk through what those are. So your now expenses, or your now bucket, are things that you need in the short term. So it's known expenses. Perhaps you have
rent, mortgage,
day-to-day
spending.
Exactly. Or it could be a little bit lumpier, like a one-off. Say, you need to upgrade your car in perhaps 2 years' time. You get the sense that it's coming to that point in your life. Or you have a particular health event or something that's going to happen that requires you to have a sum of money set aside. That's your now bucket. And the sad reality of the current interest rate environment is your now bucket really does need to be in cash. So regardless of what's happening with interest rates, it's just a portion of money in your overall wealth portfolio that you really need to have in liquid, accessible cash. The second one is your soon bucket, and that is a little bit similar to your now, except we would say it typically has a relatively fixed time frame, but it isn't immediate. So it isn't necessarily something that you're going to need to spend in 6 months, but it has a known time frame. So a couple of examples of this, I've put here, high school fees. You probably know when your kid's going to start high school. It has a fixed start date, but it may not be within the next 2 years. A couple of other things here, medical, dental, something that's sort of a little bit more medium term, but is definitely known. Anything I had on that?
Like buying a house.
Yeah, exactly.
Deposit for your house.
Exactly.
You're wanting to buy that first home in 3-4 years' time. You have a rough timeline, and you're going to need that money at some point. So you're building towards that.
Yeah, perfect. So that bucket, similarly to the now bucket, is typically what we would call expenses or goals that require more defensive assets, more liquid cash, and more accessibility, depending on the time frame and the type of goal that it is. So a great example of that is high school fees. There's a known start date, and you know that you probably have to pay those fees before your child is allowed to start school. So it really does have a very fixed time frame, and at a certain point in time, you'd need that money in cash. A house deposit, however, might also be a soon expense, but it could be a little bit flexible, because any of you that have bought a property before know that typically you don't get to just walk into your first auction and buy the house that you bid on first time round. So there's definitely a little bit of flex time there, but you also need it to be accessible at some future point. So there are a few things to think through. Typically, we would say for soon expenses, you probably do need some cash. You can possibly consider things like term deposits or some more defensive investments to suit that goal. So then we get to the later, and that's what we're really talking about today, and where some of the fun starts. So how we describe later is goals or spending requirements that genuinely have no fixed date. So when we think about that first response here and what people told us about, really, they're growing their wealth for no specific goal. They're talking about using their later bucket. So this is really what we're going to talk about today in terms of designing a portfolio to suit your later needs, whatever they may be, because that's the bucket that you typically have the most flexibility on in terms of number of years for that money to be invested, and flexibility of time frame. So I think a great one that you often talk about is, we don't retire the day we turn 65. Oftentimes people have an idea in their minds of when they might like to retire, but the reality of when that day actually happens is often quite variable depending on what's going on in that person's life, in the years leading up to that. And typically we just have a little bit more flexibility than we think we do. So that bucket is what we're talking about today. So that's interesting though, because obviously with that flexibility, obviously increases the range of options that you have. So it can become more overwhelming. And so hence why we wanted to do this session, because we have a lot of questions around, well, what am I meant to invest in? Because all of a sudden people have the universe as an option, right? And so how do you think about the simple things that are going to make it really successful investing experience for you so that you will get towards that goal? Absolutely. So when we're focusing on the later bucket, we've looked at our goals, we know what they are. We've looked at our horizon, so our now, soon, later. And at this point, we're now ready to think about, okay, we're investing for later. What does that pot of investments or that, pool of assets look like? And how do I start to think about it? So at a very base level, the first thing is thinking through things like your risk tolerance and also diversification. So risk tolerance is one of those kind of bit boring. Yeah, I was going to say yucky jargon words that really just means how comfortable are you taking on fluctuations ups and downs in the variation of that asset base, knowing that you have probably 5, 10, 15 years for that to happen. So I think sometimes people can overcomplicate risk profile or tolerance when thinking through they need to complete, a 15 questions questionnaire to tell them that there may be a conservative person or a balanced person. And I just sort of say, if you want to keep it simple, just really think about what that goal and that time frame is, because the unfortunate reality is if you are super, super risk averse and you feel very uncomfortable with volatility, but you have a goal that you're working towards in 20 years, you're probably not going to get there if you just keep it all in cash because you feel very nervous about, risk in general, or thinking about shares and equities is risky. That's just not going to happen. So what we're talking about today is, it's a long-term goal. You've got a long-term time horizon to really ride out any ups and downs. So it would make sense that you can take on the ability for, some equity exposure, some share market exposure, the assets that will perform over the long term and ultimately get you towards your goal. I think you had off the top of your head the sort of, if someone's feeling a little bit nervous about time frame and risk horizon, the average time frame that you really needed to be invested to not essentially lose any money in equity markets?
So sometimes I think you'll see that, probably more so you'll see it with your KiwiSaver or any fund that you typically invest in will have what's called this sort of time frame, and they vary, and it's just a figure that somebody makes up and puts in there. But roughly, you'll see if it's just a general equity fund or growth KiwiSaver type fund, you'll typically see these recommendations for 5 to 7 years. Now, the reason being for that is that if you look at the New Zealand equity market and most global equity markets, I don't think there's ever been a period where if you've been invested for 6 years that you would have had a negative return. And so that's why we've kind of got that longer term thinking when it comes to investing in shares, is that you do need to have a relatively longer horizon or investment time frame to be thinking about to ensure that you will get a good outcome from all of this. Now, we know that over the long term, equity markets will go up more than, particularly at the moment, money sitting in the bank. And so you do need to be invested. You do need to ride those ups and downs. But obviously, if you've got that time frame, you've got time on your side, you're really well positioned to grow your wealth and reach those goals by investing.
Yeah, absolutely. So I think, getting yourself comfortable with the prospect of risk and also understanding what volatility means, this year has been a perfect example. Probably many people have learned, what can happen in good and bad scenarios. So it's been a really great year, I suppose, for financial education in that sense.
And that can put some people off, right? Obviously, when the markets go down 30, 40%, now the funny thing is now they're actually up. So if you'd been invested for the last 12 months, you've actually still had a positive outcome, even though that the markets went down significantly, they have rebounded. And so that's a great reminder to a lot of people who may have been sitting outside that you do need to be invested and stay invested. Don't change your investment portfolio or habits based on what's happened in the news today. A really good thing that maybe you do want to mention is that we have a calculator for that. So on our website, we actually built a calculator that you can go and play around with. I think the last 10 or 15 years, we'll be expanding on that soon as well, and see exactly how an investment over different periods of times would have performed. And unlike all the other calculators out there, it's not just a generated number, it's the actual market return. So you can see exactly what you would have had by being invested over different time periods if you were regularly contributing. And hopefully that gives you some comfort to see actually over the long term. It's a really good thing to be well diversified and invested.
I think it is definitely good. I'll put a link to it in the comments because it does include data back past the GFC, and then of course we have updated it recently to include this calendar year's data. So it just gives you a good sense of, even if you invested right before the GFC hit and went through a period of 12 to 18 months of a downturn, at what point did your funds and your portfolio start to generate a positive return, and then where did you get to in sort of 5, 10 plus years? I think thinking through your later goal and focusing on that goal rather than necessarily reacting to market movements is what we always encourage people to do, because the reality is, even if, like in March, a downturn happens, as long as your goal and your financial situation hasn't changed, there shouldn't be any reason why you are reacting to that news or what's happening in the market at that point in time. If your dream of buying a batch is still 10 years away, that's fine.
It's quite good because we actually have a lot of Kernel customers are also regularly contributing to their investments in the same way that you do with KiwiSaver. They're often regularly just putting something away every week or every fortnight, be it $1 or $100. And actually those ups and downs are great because that means that you're buying more across time through those different periods. And so it also helps to disconnect from that, to keep focus on that long-term goal.
and you get a positive outcome from a downturn, really, if you're regularly investing, because you'll eventually have some great returns from that. So the next thing we're going to talk about is diversification. This is something that we do get some questions on, and I know some of our great customers sent through some questions specifically on this, because diversification can be overcomplicated, and it actually is a lot more simple than you possibly necessarily think. So just here, I mean,
so you want to say why? So we often talk about everybody knows they should be diversified.
Yes.
But do you want to say actually why?
Yes, absolutely. So, I mean, the classic line is, diversification is having your eggs in many baskets rather than one basket, because if you drop one basket or something happens to that one basket, everything cracks. And the reason why diversification is important is essentially to maximize your chance of success to get to the goal that you're aiming for. So let's say you have a goal in 15 years time, and you decide that you're going to save for that goal by investing in one single company or one single investment, and you're basically putting all of your eggs into that one basket. There's quite a lot of risk riding on the success of that one single thing to perform over the full 15 years to get to your end goal. If, however, at the very start, you put your money and your investments into a range of different companies or a range of different sectors, your chances of that combination of companies and sectors and underlying investments performing over the 15 years is much, much higher, because the impact of any one of those being unsuccessful is much more diluted.
As some real practical examples of that, we ran the numbers recently for some advisor conferences that we were doing. And if you looked over the last 15 years of the New Zealand share market, all the companies that have been on the share market, I think it was something like 20% had gone negative 50% return or more over that period. Quite a large portion had gone bust. And what's also really interesting is that over 75% of all of those companies underperformed the market as a whole. So as an investor, again, like if you just pick one company and only invest in one company, you have pretty high odds that that company is either going to perform very poorly, or it's actually just going to do worse than what you would have got by just owning a well-diversified fund. So that's where the diversification comes in. As to Kat's point, though, we see some people where diversification adds value only to a certain point. Going and buying 100 funds with each of those funds already having hundreds or thousands of companies in it isn't doing anything more for you. You're probably just increasing your costs and complexity. You just want to make sure that you're diversified across, as to the chart that we showed, a range of sectors. So, you've got some exposure to property, a range of markets. So you've got investments across different countries and geographies. And that's going to ensure that things are, going to ride out the different ups and downs over time. Yeah.
I think, as Dean said, the number one thing that we see is that people probably overcomplicate or over-diversify. If you're thinking about investing in index funds or ETFs, it is different to, say, investing solely in shares. So if you're just picking shares, you do need quite a lot of different individual companies to be diversified. If you're investing in an index fund or an ETF, you've already got the benefit of diversification within that one fund. So you don't then need to go and pick 20 different funds, because the chances are is you'll have a relatively high crossover between underlying holdings in those funds, or you're just overcomplicating your portfolio for the sake of it, and you're diluting any benefit of doing so. So that's definitely one thing that, if you're already into index investing, which I'm guessing you are if you're watching this webinar, you don't need to pick too many funds to complement each other and get yourself the benefits of diversification.
Yeah, and if you're starting like 2 funds and you could be done, just get started. I think that's another thing that we talk about. If you're newer to investing and you're really just trying to figure things out as you're going along, start with 1 or 2 funds, add in more options over time as your portfolio grows, as your investment grows. And as you become more aware of sort of what's going on and what you want to achieve, one or two well-diversified index funds is a great place to start, and then to build from there. Don't rush out and go and try and buy everything.
No.
Keep it simple and go from there.
Definitely. So that's the third main thing. The fourth that we wanted to touch on today is, once you've thought through, okay, we've done our goals, we've looked at our horizon and our now soon later, we've thought a bit about risk and diversification. Then when it comes to actually picking the funds that are going to fit into your portfolio, there's one really good concept that we wanted to run through around how a portfolio can fit together. And this is called core satellite investing. So it's not super well known in New Zealand, but it's something we talk about a lot. And I'm just going to give you a really simple example. So if you're thinking about core satellite, here's our lovely little graph. You're basically looking at the core of your total investable money. So when we're talking about total investable money, we're talking about funds that you actually have available, or cash flow you have available to set aside for that goal that you're working on. And 80 to 90% of that needs to be invested in what is called your core. So the idea of this core portion is that it is really low cost, highly diversified, and very easy to access and transact on. So typically we would say your core needs to be an index fund, because, tick, tick, tick those boxes. You've got diversification, you've got low cost, and you've got ease of access.
Couple of examples of funds that we've done that.
Yeah, so what we would typically say is that kind of our core funds for the New Zealand market would be the NZ20, because it's very broad exposure across some large parts of the market in the New Zealand share market. Globally, it would be the Global 100. So basically the 100 largest global companies around the world. And basically that would be essentially a core. Then if you're looking at what is a satellite, it's essentially a satellite pick, or a small, it's a little star sitting around your center moon, which is your core. So they're things that
can be more speculative.
Yeah, something you're interested in.
Higher risk, potentially more. They could be anything. It could be single stocks. It could be an index fund, but an index fund that's got exposure or investments in more speculative companies.
Or a particular tilt. So I think, and then if you're thinking about those percentages again, so if you've got your 80 to 90% of your investable funds going into your core exposure, you can have a couple of different satellites here, but the important part is that these satellites don't make up the majority. They are smaller picks. So that's your 10 to 20%, depending on your comfort level of your total investable wealth. So the idea there is, yes, you get broad diversified market exposure in your core that's basically going to ensure that you get towards the goal that you're working towards. And then you've got your satellite picks that could be, as Dean said, something you're interested in, something that's a little bit more fun, perhaps an opportunity that, popped up. But the point with that is you're not putting all of your funds into those slightly more speculative, risky, niche areas of the market. So I know for me personally, I don't have any satellite picks because I just don't really have the time and energy to want to do that. I'm really happy with just having 100% core in terms of my investment portfolio, and then knowing that I have other interests like being, interested in a property that I kind of think about as my satellite. But I do know, as an example, that Dean has satellite picks because he does like to dabble a little bit with individual shares now and then.
It's I like to have some more speculative funds on the side. But again, it does take more energy. It is part of the portfolio or your investment that probably takes up more of your energy or interest. But if you are quite interested or you want to be quite engaged, it's a great place to draw your attention. As Kat said, just reinforcing that the core part, actually, once you've decided what your core looks like, the beauty of it actually is that it's really boring and you don't need to do anything with it. And in an ideal world, you will have a regular contribution to it, or you'll set and forget, and you will look at it once a year, and you can know that you're on the right track and you're going to reach your goals. The satellites, you don't need the satellites to reach your goal. The key with those are they may help you outperform. They could also underperform, and that's why you don't want to put too much in them or not too much in any one satellite either. But the nice thing to think about really is that the core is all you actually need to get towards your goal. The satellites are there if you want to take on a bit more risk or a bit more speculation, or it's a part of your portfolio that you just want to have some interest and some fun with. So
yeah, which is perfect.
yeah.
So I think that's for us for today. When you're thinking about the very first, starting point for obviously portfolio design, the number one, just to recap, is your goals. So what is it that you're investing for? What is that later goal that you really want to achieve? And then thinking through, what does your later time horizon look like? Is it 10 years? Is it 15 years? Is it an undated time frame that you have some flexibility on? Once have your thinking clear around that, then it's certainly thinking through things like risk and managing risk through the benefits of diversification. So making sure that you are using some well-diversified funds to achieve that for you. And then deciding whether or not something like core satellite is for you. So do you want to keep it really simple like I do and just have some core funds that you want to put on set and forget, a regular investment, and check in every now and again and make sure that you're on track to meet your goal? Or do you have a little bit more of a passion and interest in looking at a few different individual companies or some interesting sectors of the market, and do you therefore want to add those into your portfolio as well as a satellite pick? So they are your starting points for today. In our next webinar, we're going to run through, once you've gotten to this point, how do you think about putting your funds together, and what are the different considerations you need to think about in your age and stage when you need to start thinking around introducing things like fixed income or income producing assets into your portfolio, and how that might work for you. So stay tuned for that, and we look forward to chatting to you soon.
Thanks.